Time once again to check on the latest earnings trends with Zacks Director of Equity Research, Dirk Van Dyke. Dirk, there's very little in the way of any fresh news on the earnings front, but suffice to say, we're probably looking at another weak quarter. And if so, that would mark the 7th straight quarter of negative earnings growth. Haven't seen that in about 10 years.
Yeah, at least. I mean, but then again, we don't have recessions all that often, and this is a real nasty one. We'll probably also have an 8th quarter in the second quarter as well. Yeah, right now on a total net income basis, for the first quarter, we're looking at a down 37.5%. Second quarter is more like down 30. Now that's better than the fourth quarter when we were down 62. So maybe you can say we're making progress, but an awful big chunk of that down 62 in the fourth quarter was the AIG and Citigroup, mega losses. Let's hope and pray we don't see another, $60 billion loss in the quarter for, an AIG.
Right. In the first quarter, how many companies do you think may miss lower expectations?
Well, I mean, traditionally we always have more positive surprises than negative surprises. Even in the fourth quarter, we had about twice as many positive surprises as negative surprises. The magnitude of the negatives were much bigger, however. I suspect that we'll again have more positive than negatives, but it'll be a narrower margin than certainly we became accustomed to during the good times when it would regularly run at over 3 to 1. Maybe 3 positive surprises for every 2 negative surprises. But by definition, surprises are just that. I mean, so far we've got 11 companies reporting, so it's not a big sample, and it's actually 5 positive, 5 negatives, and 1 right on the target. So,
as far as sectors are concerned, which ones are you expecting the lowest growth rates in?
Is in the biggest red ink.
Yeah.
Well, consumer discretionary has to be at the top of the list. Financials have easier comps, and so their expectations are actually sort of in line with everybody else. I mean, there's kind of just healthcare, utilities, and staples are supposed to be just this minor losses, and then everybody else pretty much loses 25% or more. And so financials is in that group, but the real
financials may even benefit from those easier comps, won't they?
Well, yeah, I mean that's the point of having easy comps, is it makes you have some. It's a lower hurdle to get over.
So they could actually come out looking like the best performers.
I wouldn't go that far, but I mean the real cyclical areas of the economy are likely to be hurt the most at this point in the cycle. That's the consumer discretionary, some of the materials stocks, some of the industrials, and energy. I mean, talk about financials had easy comps. Energy had really, really tough comps. I mean, congressional witch hunt type positive profits that no longer are there. But I mean, there is even some hope there because we've seen energy prices rebound. Probably aren't going to help the first quarter that much, but further down the road, if these higher prices, I mean, still well below a year ago levels, but certainly much higher than they were 2 or 3 months ago.
Given all of the downward revisions for first quarter, how are you expecting the PE ratios to do? How are they doing right now?
Well, I mean, we have days like yesterday, they start going up in a hurry, kind of regardless of what's happening on the earnings front.
Yesterday being March 23rd, as we tape this on the 24th.
So it's now. I mean, the market does obviously seem very exuberant about finally getting the details of the toxic asset plan. And that should be helpful to the financials because they'll finally get some of their toxic assets off the prices, and you now have a fairer way of determining what the actual assets are worth. I suspect that the investors in this plan are going to make out like bandits, the BlackRocks of the world, because I mean, essentially, on those loans that work, they're going to make a fortune. On the loans that don't work, and they're going to lose everything. But that everything is a very small part of the overall pie, and because it's non-recourse lending,
Right.
and so it's I think it's got to be a positive for. I mean, BlackRock's the only direct play. There are only 5 funds that are going to be initially invested or invited into this.
Right.
BlackRock's one that it's a slam dunk that's going to be a participant there.
All right, we're going to leave it right there. If you want to read Dirk's latest earnings trends piece, go to Zacks.com's homepage and scroll down until you see his picture and the headline, the most current headline, right next to it. With Dirk Van Dyke, I'm Terry Ruffalo.